All right, let's face it. Student loans are the modern day adulting initiation ritual. You graduate, you throw that cap in the air, and boom, here comes a debt so big it could probably have its own Netflix special. Am I right? But don't worry. Today on Building Success, we're tackling the beast head on. By the end of this video, you'll have a strategy to crush your student loans and finally breathe a little easier. Before we dive in, don't forget to hit that subscribe button for more tips on mastering your money and building a successful life. And hey, if you find this video helpful, give it a thumbs up. It helps more than you know. First things first, let's figure out what you're actually dealing with. Federal loans, private loans, interest rates, repayment plans. Knowing the specifics is crucial because all debt is not created equal. Think of it like assembling IKEA furniture, except instead of an Allen wrench, you need knowledge. Let's break down federal versus private loans. Federal and private student loans are the two main types of loans available for financing higher education. Here's a breakdown of their differences. Federal student loans are loans funded by the U.S. Department of Education. They come with several benefits designed to help students succeed financially. Federal loans typically have fixed and lower interest rates compared to private loans. Borrowers can choose from a variety of repayment plans, including income-driven plans, which base monthly payments on your income and family size. Some federal loans qualify for forgiveness programs, like Public Service Loan Forgiveness, or PSLF, for those in qualifying careers. For undergraduates, subsidized loans do not accrue interest while you're in school or during deferment periods. Most federal loans don't require a credit history, making them accessible to many students. Private loans are loans offered by banks, credit unions, or online lenders, and they vary greatly depending on the lender. Interest rates can be fixed or variable, and they're often higher than federal loan rates, unless you have excellent credit. Private loans generally have fewer flexible repayment options, and they don't offer income-driven repayment plans. Private loans are not eligible for federal forgiveness programs, and private loans require a credit check, and having a cosigner with good credit can improve your chances of approval and reduce interest rates. Private loans can sometimes cover the full cost of attendance, whereas federal loans have annual and aggregate limits. The key takeaway here: federal loans are generally the better first option because of their borrower-friendly terms, especially for students just starting their financial journey. Private loans can fill funding gaps, but should be approached with caution due to stricter repayment terms and higher interest rates. Let's discuss some key terms you'll need to understand. Interest accrual refers to how interest builds up or accrues over time on the loan balance. The amount of interest you owe depends on the loan type, the interest rate, and how often the interest compounds. For subsidized federal loans, like direct subsidized loans, the government covers the interest while you're in school at least half time, during your grace period and during deferment. For unsubsidized federal loans and private loans, interest starts accruing as soon as the loan is disbursed. Even if you're not making payments, for example, while in school or in deferment, the interest adds up and capitalizes. This means unpaid interest gets added to your loan principal, increasing the total amount you owe. Private loans often compound interest more frequently, such as daily or monthly, which can make the total cost of borrowing higher compared to loans that compound less frequently. Grace periods. A grace period is the time after you graduate, leave school, or drop below half-time enrollment when you're not required to make loan payments. Most federal loans offer a 6-month grace period. For example, direct subsidized and unsubsidized loans. During this period, subsidized loans do not accrue interest. Unsubsidized loans accrue interest, which capitalizes after the grace period ends. Grace periods for private loans vary by lender. Not all private loans offer grace periods, and those that do often have less favorable terms. For example, the interest always accrues. The key takeaway here is understanding when interest accrues and how grace periods work can help you minimize borrowing costs by making payments on interest even before the grace period ends. It's worth reviewing your loan terms to plan a repayment strategy. I've had plenty of personal experience with student loans. In high school, I was fortunate enough to work hard, get good grades, and receive some decent scholarships. And then while I was in college, I did a student work job, working. It wasn't glamorous, but I worked as a janitor my freshman year at school. Worked 6 to 8 a.m. because you could get a $1 shift premium by working early in the morning. So I jumped on that. And then later, student job was as a note taker in classes, which was fantastic because I could get paid just for attending classes that I was already planning to attend, or alternatively, I could sign up as a note taker for other classes that I wasn't taking and basically get the class for free and all the knowledge that I learned from there while getting paid. It was a fantastic job, and I would encourage, if you are in school and thinking about student loan repayment, think about what kind of jobs you can take to minimize the amount that you need to borrow. And then finally, once my loans were paid off, and it took a period of years after I graduated, but wow, what an amazing feeling to be able to say, okay, now I finally own that piece of paper. I own that diploma, and my education is mine now. And that is why step 1 is know your enemy, understanding your loans. Next up, the battle plan. You need to budget. And before you roll your eyes, let me tell you, a budget isn't a punishment. It's freedom. It's you telling your money where to go instead of wondering where it went. If you don't have a budget yet, please click on the link above to learn more about how to budget your money. In that video, I introduced the 50-30-20 rule, which is a simple budgeting framework that allocates your after-tax income into 3 categories: needs, wants, and savings/debt repayment. Adding a student loan twist can help prioritize paying off your loans while keeping your finances balanced. Here's how it works. So the original 50-30-20 rule allows 50% for your needs. So this includes essentials like your rent, your mortgage, your utilities, groceries, insurance, transportation, and minimum payments on your debts. So this would include your student loans. Then 30% for wants. So this is the non-essential spending, like eating out, subscriptions, entertainment, travel, and all those hobbies you might have. And then finally, 20% for savings and extra debt payments. This is your emergency fund contributions, your retirement savings, any investments you may have, and now any extra payments on student loans or other debt that you might have. So if we think about the 50-30-20 rule with more of a student loan focus, you need to adjust your budget to prioritize those loans. So if your student loans are a major part of your financial goals, you can tweak the rule by reallocating funds from wants or savings to speed up your repayment. So an example of what this might look like is your needs would still remain at 50%, and that's, again, including your minimum loan repayments. Your wants would need to be reduced to maybe 20 or 25% temporarily. And then your savings and debt bucket, that needs to increase up to, say, 25 or 30%, because you need to allocate that extra toward the student loans. The second step is reallocating debt payments based on the loan type. So use your savings and debt repayment bucket strategically. Pay minimums on the federal loans if you're in an income-driven repayment or IDR plan, or if you're pursuing forgiveness programs like PSLF. And don't worry about all these acronyms. I'll cover these in greater detail later in the video. And then apply extra payments to your high interest loans. Usually these would be any private loans you may have to save on interest. Step 3 is combining savings and debt goals. Your emergency fund comes first, so you need to build 3 to 6 months of expenses in an emergency fund before you're making any aggressive extra payments on those loans. Don't pause your retirement savings entirely. Aim for at least the employer match if available. So if your employer offers an employer match in your 401k plan, you definitely want to still contribute up at least to the amount to get the employer match. And I'll provide an example budget here. So suppose you have $4,000 after tax income. Well, with our standard 50-30-20 rule, you would have $2,000 set aside for your needs. You would have $1,200 set aside for your wants, and then you'd have $800 set aside for savings or debt. If you're focusing on student loans, well, you're still going to have $2,000 in that needs bucket. Your wants is going to be reduced, right? You might take that down to, say, $800 per month to cover dining out, entertainment, hobbies, travel, things like that. Now, your savings or debt payments need to increase. So that's going to go up from $800 up to $1,200. And again, that's for getting that emergency fund created first and then getting those extra loan payments out there. So you'll note here with the student loan focus, $400 of wants is shifted to savings and debt repayment for faster loan payoff. So some student loan specific adjustments here. You want to prioritize high interest loans. If you have federal loans at low interest rates, like 3 to 5%, when I was in college, loans were down in that 3% range. And private loans with higher rates, say 7% plus, use the 20% bucket to aggressively pay down the high interest loans. Explore refinancing for better terms. So lowering your interest rate through refinancing, it could free up more cash flow to allocate across the budget. Leverage loan forgiveness. So if you're pursuing forgiveness, for example, through PSLF, keep payments low by sticking to the IDR plans. Redirect the 20% savings bucket to other priorities like retirement or an emergency fund. And again, I'll cover more on PSLF and IDR later in the video. So some of the pros for the 50-30-20 rule for loans, it provides a balanced approach. It keeps you focused on loan repayment without neglecting other financial goals or burning out. It is customizable. You can tweak percentages as needed to match your financial situation. The 50-30-20 rule encourages discipline. It forces you to live within your means while working toward debt freedom. Now some cautions. Don't sacrifice your emergency savings. Avoid redirecting all your savings into loans at the expense of an emergency fund. It's your financial safety net and you need that. Reevaluate as income changes. So if your income increases, revisit the rule to allocate more towards savings or debt repayment. Avoid loan burnout. So it's okay to enjoy some of your money. For example, if you wanted a slightly higher wants percentage, if it helps to keep you motivated. There are a variety of apps and tools available to help you manage your student loan debt. Examples include Mint, You Need a Budget, or the Student Loan Calculator app. Think of it like this. Every dollar you throw at your loan now is one less dollar future you has to pay with interest. You'll thank yourself later when you're sipping pina coladas by the ocean debt-free. And that covers step 3, have an attack plan, budgeting for repayment. Now here's the secret sauce, paying smarter, not harder. Refinancing student loans can be a smart move if done strategically. Here's a plan and a rundown of potential risks to consider. 1. Assess your current loans. Determine the type, whether it's federal or private, interest rates, and repayment terms. Federal loans come with unique benefits, for example, income-driven repayment plans and loan forgiveness, which you could lose when refinancing. Improve your financial profile. So you build good credit. You want to aim for, say, 700 plus on your credit score. Lower your debt to income ratio by reducing other debts or increasing your income. A strong financial profile will get you better interest rates. Shop around for rates. Compare offers from multiple private lenders. Many offer pre-qualification, which shows potential rates without affecting your credit score. Check for perks like flexible payment options, auto pay discounts, or deferment options in case of hardship. Choose fixed or variable rates wisely. Fixed rates are stable, but higher. Variable rates may start lower, but then they can increase over time, making them riskier in a volatile interest rate environment. That's why I tend to lean more toward fixed rate loans. Match terms with goals. Shorter terms save on interest but increase your monthly payments. Longer terms lower the payments but increase the total interest costs. You can consolidate multiple loans for simplicity. And that's what I did when I was repaying my loans. So if you have multiple loans, you can refinance them into one loan with a single monthly payment, and that's going to help to simplify your financial management. Evaluate customer service. Read reviews of lenders to ensure that they have a strong reputation for customer support and repayment flexibility. There are some risks to consider. So, loss of federal loan benefits. So, refinancing federal loans into private loans means forfeiting income-driven repayment plans, public service loan forgiveness, or PSLF, and temporary deferment or forbearance protections. There's also a risk of higher long-term costs. Lower monthly payments through longer repayment terms can result in paying more interest over time. Variable interest rate risks. If interest rates rise, your payments on a variable rate loan could increase significantly. Credit and income requirements. You might not qualify for the best rates if your credit score or income is insufficient. In this case, you may need a cosigner, putting their credit on the line. Lack of flexibility in private loans. Unlike federal loans, private loans often lack flexibility for payment pauses during financial hardship. Early repayment penalties or fees. So some lenders charge fees for prepayment or refinancing. So you need to read the fine print carefully. So the bottom line on refinancing is that it can save you money and it can simplify repayment, but it's not for everyone in all cases. If you rely on federal loan protections or expect to qualify for PSLF or other forgiveness programs, refinancing may not be worth it. However, if your goal is to lower your interest rate and you're confident in your financial stability, it could be a game changer. Income-driven repayment, or IDR plans, are federal student loan repayment programs designed to make monthly payments more manageable by basing them on your income and family size. They can also lead to loan forgiveness after a set period. Here's how they work and an overview of forgiveness options. Let's talk about income-driven repayment plans. There's several types of IDR plans. There's the revised pay-as-you-earn, where payments are 10% of your discretionary income, and forgiveness is 20 years of undergraduate loans or 25 years for graduate loans. There's no income cap. So payments could rise significantly with higher earnings. There's pay as you earn. Payments are 10% of discretionary income, but never more than the standard 10-year repayment amount. Forgiveness is 20 years. And for eligibility, you must demonstrate financial hardship and be a relatively new borrower. So that's loans after October 2007. Income-based repayment, or IBR. Payments 10% of your discretionary income for new borrowers after July 2014, or 15% for others. Forgiveness is 20 years for new borrowers or 25 years for others. And the monthly payments capped at the 10-year standard plan amount. There's income contingent repayment, or ICR, where payments are 20% of discretionary income or a fixed amount over 12 years, whichever is less. Forgiveness is 25 years. The only IDR plan available for Parent Plus loans after consolidation. So how are the payments calculated? So let's talk about discretionary income. That's your adjusted gross income, or AGI, minus 150% of the federal poverty guideline for your family size and state. Payments adjust annually based on income and family size. How about eligibility? So you must have federal loans, so direct loans and some FFEL loans after consolidation. Parent Plus loans are only eligible under ICR after consolidation. What are the loan forgiveness options with IDR? So there's forgiveness after repayment period. So any remaining balance on your loans is forgiven after 20 or 25 years of qualifying payments under an IDR plan. Note that the forgiven amounts are considered taxable income as of the 2024 rules. Public service loan forgiveness, PSLF. So for eligibility, you need to work full-time for a government or nonprofit organization and make 120 qualifying payments under a qualifying repayment plan. IDR plans qualify. The benefits are that the loan balance forgiven after 10 years of qualifying payments. Forgiven amounts are not taxable. Teacher loan forgiveness. So for the teachers out there, that forgives up to $17,500 for teachers who work full-time in a low-income school for 5 consecutive years. Can be combined with PSLF, but not simultaneously. Income-driven repayment forgiveness for Parent Plus borrowers. So Parent Plus loans are eligible for forgiveness under ICR after 25 years of payments. So some of the pros of IDR plans. Lower monthly payments, often making them affordable during financial hardship, forgiveness after the repayment terms or through PSLF, payments adjust with income, reducing the financial strain. Some of the cons of IDR plans. Extended payments means you'll likely pay more in interest over time. The forgiven amounts outside of PSLF are taxable, which can lead to a significant tax bill. Annual recertification is required to stay on the plan, which can be time-consuming. And if your income increases substantially, you may end up paying more than you would on the standard plan. So is an IDR plan right for you? IDR plans are ideal for borrowers with high debt relative to income, those in public service careers for PSLF, or anyone facing financial hardship. However, if you can afford standard payments or are looking to minimize total repayment costs, other strategies may be better. Making extra payments or rounding up your monthly student loan payments can significantly reduce the total amount of interest you pay and shorten your repayment term. Here's how it works and why it's effective. Extra repayments are huge. So when you make extra repayments on your student loans, the additional amount goes toward the loan's principal balance after any accrued interest is covered. This reduces the balance faster, leading to less interest accruing over time. Some of the strategies for extra payments. So you could pay bi-weekly instead of monthly. Here you split your monthly payment in half and pay every 2 weeks. This results in 26 half payments or 13 full payments each year, effectively adding an extra full payment annually. It doesn't sound like much, but trust me, it adds up. You can add a set extra amount each month. So for example, if your minimum monthly payment is, say, $250, pay $300 monthly. Over time, that $50 a month extra can save thousands in interest and years of repayment. Lump sum payments too. So if you have a windfall, so like if you get a large tax refund, you get a bonus or a gift or inheritance, use those to make one-time extra payments toward your loan principal. A common method is to target the highest interest loan first. So if you have multiple loans, focus the extra payments on the one with the highest interest rate first, while maintaining the minimum on others. This is known as the avalanche method, and it saves the most money long term. Another low-effort method to chip away at your loan balance faster is to round up your monthly payments. So the way this works is you can round your monthly bill up by the nearest $10, $20, or $50. So for example, if your monthly payment is $237, round it up, pay $250 or $300. The extra, in this example, $13 to $63 each month, that directly reduces your principal. That has an impact over time, so even small amounts add up. Adding $25 per month to a 10-year, $30,000 loan at 5% interest rate saves over $1,700 in interest and shaves about 11 months off of repayment, nearly 1 year off of that 10-year loan. So the key benefits here, obviously it's going to save you on interest. Every dollar paid toward the principal reduces future interest charges. It shortens the loan term. You'll pay off your loan faster, which means less time in debt. And then additional flexibility. So you control how much extra you pay, allowing you to adjust based on your financial situation. Some things to watch out for. You need to ensure that the extra payments actually go toward the principal. Some loan servicers apply extra payments to future installments instead of reducing the principal. That's not what you want. You need to specify that your extra payments should be applied to the principal balance. Check for prepayment penalties. So federal loans have no penalties for prepayment, but some private lenders might. Review your loan agreement or ask your lender. Keep your emergency funds intact. Don't overextend yourself. Ensure you still have money for emergencies or your other financial goals. And you need to balance your extra payments with other financial priorities. So consider paying off the high interest debts like credit cards or investing into retirement accounts before aggressively paying down low interest student loans. So the bottom line, making extra payments or rounding up your monthly payment can accelerate your debt payoff and save you money in the long run. Even small changes like an extra $20 per month can have a big impact over time. Listen, I know the idea of throwing your hard-earned craft beer money at your debt hurts, but trust me, the suds can wait. Freedom tastes better. Friends, that was step 3. Pay smarter, not harder. Here's the bottom line. Student debt doesn't define you. It's a hurdle, sure, but hurdles are meant to be jumped over. Take control, one step at a time, and you'll build the financial future you deserve. Thank you for hanging out with me today on Building Success. If this video helped you, share it with someone who's battling student loans. And remember, every small step towards financial literacy is a giant leap toward financial freedom. See you next time.